Hello and welcome. My name is Jin Choi and I'm the founder of Money Geek. And welcome to the fourth episode of the short course on investments. And today we're going to cover bonds and GICs. Simply put, a bond is someone's debt. So if you own a bond, that means someone owes you money. So for example, if you own a Canada savings bond, that means that the Canadian government owes you money. And if you own a Tim Hortons bond, that means Tim Hortons owes you money. Bonds have three important characteristics that you should care about. So they are maturity, credit rating, and yield. So let's start with maturity. Simply put, maturity is when the bond gets paid back in full. So for example, if you own a Tim Hortons bond that matures on June 1st of 2017, that means Tim Hortons will pay you back all that they owe you on June 1st of 2017. Now, some people have asked me, does that mean that you're locked in until maturity if you buy a bond? And the answer is no. You can actually buy and sell bonds very easily. Bonds are very liquid investments, and you can usually buy and sell them within seconds. Now, the second most important thing that you should keep in mind when it comes to evaluating bonds is credit rating. So credit rating just tells you about the likelihood that the borrower will default. So if it has a high credit rating, that means the borrower will likely not default. And as you can imagine, if you own a bond of large, stable companies, or if you own bonds of Western governments, such as Canadian or US governments, then the credit rating is very high and the likelihood of default is very, very low. But you should be careful because if that ever changes, so if the credit rating deteriorates, then the bond prices can actually tank well before it actually defaults. And the third important thing that you keep in mind when it comes to bonds is yield. And yield is not the same thing as a coupon. So let me explain what these two things are and why they're not the same. So let's say that you have a bond and the principal of that bond is $1,000, which means that in maturity, the borrower will pay you back $1,000. In the meanwhile, before it matures, every year it will pay you $50. And that $50 is called the coupon. So in this example, the coupon rate is actually 5%. Now let's say that you bought this bond at $1,000. And let's say that this bond matured just a year from now. Then a year from now, you will have received $1,000 plus the $50 in coupons. So at the end of the day, you will have made a $50 profit for a $1,000 investment. So the yield of this bond is 5%. So in this case, the yield is the same as the coupon. But what if you didn't buy the bond at $1,000? Because like I said, you can buy and sell bonds after you purchase them. So it's quite possible to buy bonds at a different price than the principal. In fact, this is usually the case. So let's say instead of $1,000, we were able to buy the bond at $900. Then, unless the borrower defaults, a year from now, we'll receive the principal, which is $1,000, plus the coupon, which is $50. So a total of $1,050. In this case, the gain would be $150. So on a $900 investment, that represents a gain of 17%. And this gain, this 17%, is the yield. And that's how it was if you were able to buy the bond at $900. But what if instead you bought the bond at $1,050? Then in that case, in a year from now, you'll still receive the $1,000 in principal plus the $50 in coupons for a net gain of $0. So nothing. In this case, the yield is also 0%. Now I want to make another point with these examples. If you look at the first example, you will have noticed that when bond prices were down, yield was up. And in the second example, when bond prices went up, yield went down. And this is always the case. And by the way, before we continue, I should also mention that when people talk about interest rates, what they really mean is yield. So interest rates, yield, the same thing. Now, what controls yield? Well, among other things, central banks control yield. And they can do this because they have the power to buy and sell a lot, tons of bonds in the market. So if they think that the interest rates are too low, they can sell bonds and bring up the interest rates. If they think that the interest rates are too high, they can buy bonds until interest rates move downwards. Globally, the bond market is about 3 times the size of the stock market. So the bond market is really a bigger deal than the stock market. And that's why some people think that the chairman of the Federal Reserve, which is Ben Bernanke right now, is the most powerful person on this planet. And that's because at the snap of a finger, basically, they can say that they can make you richer or poorer. Now, when interest rates move, for whatever reason, some bonds get hit harder than other bonds. So for example, bonds with longer maturities get hit harder with each percentage of interest rate movement than bonds with shorter maturities. So for example, if you have a bond that matures in 30 years, and say that's a government bond, then if interest rates go up by 1%, then that bond's price will get hit, so it will go down by 15%. Whereas if you hold a government bond that matures in just 2 years, then with each 1% movement upwards in interest rates, the price of that bond will only get hit by 2%. And this is why we say that short-term bonds are less risky compared to long-term bonds. Now I want to talk a little bit about GICs, which stands for Guaranteed Investment Certificates. GICs are basically bonds of financial institutions such as banks and trusts. The only difference is, whereas most bonds are very liquid, GICs tend not to be. Even if you hold a flexible GIC, which lets you redeem before the maturity, you can only usually do so with a significant penalty. So for this reason, I personally like to stay away from GICs. And last of all, just as with stocks, I want to personally caution you against picking and choosing which bonds to invest in. Picking a better bond than another is possible, but it takes a lot of education and a lot of experience to pull it off. So I personally recommend against it. Instead, I think that most people should hold a basket of bonds. And if you stick with this course, you'll learn how to do just that. So that's what I had to say about bonds. So let's recap what we've learned today. We learned that bonds are debt owed by somebody. And we learned about the 3 important characteristics about bonds, which is maturity, credit rating, and yield. We learned that yield isn't the same as coupons. And we learned that when yield goes up, bond prices come down, and vice versa. And we also learned that long-term bonds are hit harder when interest rates go up. And that makes long-term bonds riskier than shorter-term bonds. We learned that GICs are really bonds issued by financial institutions such as banks and trusts. And we learned that whereas most bonds are very easily traded and very cheap as well, that's not the case for GICs. And finally, I ended with a cautionary note against picking and choosing which individual bond to invest in. So that's it for today. I really hope you're enjoying the course so far, and if you are, please consider sharing this video using the share buttons below. In the next episode, we'll talk about mutual funds. So thank you very much for watching, and I hope you have a great day.